We are about to enter March, and while we've enjoyed nothing but bullish momentum thanks to technology, are things about to change? For weeks now, traders and investors have been talking about a pullback that is yet to happen. And while some charts are looking really weak, today we're going to dive into the stats to see what actually happens in similar scenarios. We're also going to discuss the institutional view of the rally. What are they doing and what moves are they making? We're also going to be talking about earnings. Costco, CrowdStrike, and Broadcom, just to name a few, will definitely move the market. And if that's not big enough, we also have the big jobs report on Friday, non-farm payrolls. Will we beat or will we miss? There's plenty to take us off course, and this week will be defined by indecision and volatility. So without further ado, let's roll the tape. Hello ladies and gentlemen, welcome to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like these videos, please subscribe, hit that notification bell. Guys, like this video, it really helps me with the algorithm. Let's get into it. Now guys, before we get into the video, the weekend poll is currently ongoing, so you guys can vote. If you want to do that, go to my YouTube channel and just hit this community tab button right here and you can cast your vote and we will tally up all the votes on Monday. Now, this is the monthly chart for the S&P 500, the monthly heat map, and you can see very green, fantastic breadth. The only stocks that didn't perform right here, this section in consumer defensives, you can see the growth section of staples did do really well. Utilities, right? And then telecom services. So very defensive sectors didn't do well. Now you think, why is healthcare up? Well, healthcare, in my opinion, isn't really defensive. It's sort of like an all-weather stock. In a growth environment, it'll do well. In a recession, it'll do well. In a recovery, it'll do well. So healthcare is, less of a defensive name, in my opinion, and more of an all-weather stock. That being said, when we get participation in the big names, semis, Microsoft, Amazon, Tesla, Berkshire, JP Morgan, Visa, Meta, Eli Lilly, Costco, when we get participation in all of these names, the market is surely going to be up a lot. I mean, look at the mega caps. We had Google down 2%, Apple down 2.5%, and that's really it, apart from a couple of sectors here, telecom and that sort of thing. So a very bullish month, quite broad. Remember, if you think back to 2023, we were looking at these monthly charts, and what we saw was like tech was up big every single month, semiconductors too, right? And then just a couple of big names here in discretionary, Tesla, and a couple of the financial names, MasterCard, Visa. That was really it. Everything else was either like flat on the month or like red. So to see this type of participation, especially in 2024, very healthy price action right here. And then looking at sectors as a whole, I'll just quickly go over this. Semiconductors up 13%, discretionary. They're the two best sectors so far this year. The worst performing sectors was GDX, mining, utilities. And when you see these sectors at the bottom and these risk on sectors at the top performing the best, it's risk on. Sentiment is risk on right now, guys. Now guys, yesterday I broke down the S&P 500 chart on a monthly, weekly, and daily basis. Today we're going to break down the S&P 400 mid caps and then S&P 600 small caps. Looking at the S&P 400, we could see a fairly bullish trend right here with a low, higher low, and approaching all-time highs. At the same time, making a high, then approaching those highs and never really getting back to this low right here. Now, zooming in at candle structure and location, this is the February monthly candle. We opened right here, a bit of price discovery near the middle of January's candle, but we never actually got to the lows, and then buyers took us all the way up, causing a technical breakout in these charts. And this is considered a technical breakout because we broke above this area. We used it as resistance not once, not twice, but 3 different times. Resistance then became support, as you can see right here, and we've rallied ever since. And this is a technical breakout in the S&P 500 mid caps. Furthermore, we closed at the top of this green candle and we're about 0.5 percentage point away from all-time highs. We actually did close at new all-time highs on a closing basis, but on a wick basis, we're not yet there at all-time highs. Now, on a monthly basis, I would actually move this a little bit up to the open of February, and we can actually afford a pullback on a monthly basis to the 2743 level right here and still be constructively bullish and in an uptrend. If we pull back to this area right here, we would be in a technical uptrend. There'd be no technical damage and we can go ahead and break these highs. But what I would personally like to see is us open Monday, early next week, go ahead and just rally all the way, break those new all-time highs here in the S&P 600 mid caps. Now, looking at the weekly chart, let's actually actually just zoom out a little bit and look at candle structure and location, it pretty much looks very similar to the monthly candle. We opened right here, minor price discovery on the downside, buyers took us all the way up. We closed the week at the high, and we could see that we formed a low right here, a higher low, and then a high. At the same time, putting up equal highs here, a higher high, and pretty much at equal all-time highs. Now, on a weekly basis, where can we look to pull back to buy possible opportunities? Well, we can look to this level right here because it was last week's lows. Okay, if we can stay above the 2803 level, and we actually did use as resistance here, resistance does become support, and that would be a confirmed breakup. So we can actually pull back to the 2803 level and still go for those all-time highs and still be technically bullish on the weekly chart. Now, what I really want to see is just go burst those highs on Monday. Just go make new all-time highs on Monday. That would be really, really bullish. That's what I want to see in the S&P 500 mid caps. Now, on a daily chart, we can see that Friday's candle, very bullish, gap up and go. You know, the market really wants to go for those all-time highs. And I think we could actually use this level right here as a possible play to pull back. 2856. Maybe Monday we pull back to this 2856 level and then rally, hitting those highs Tuesday, maybe early Wednesday, late Tuesday, early Wednesday. But yeah, 2856 on a daily chart, 2803 on the weekly chart, and 2743 on the monthly chart. Those levels are absolutely key. Now, let's say we do go ahead and break this 2856 level to the downside. We're probably going to use it as resistance and push all the way to this level right here. This is the next level that we really need to hold. We break this and we're going to go here. And I do think at the most part, we probably will find support at the 2743 level. I don't think we're going to go lower than that. I just don't see it in the tape, especially with where we are right now and what earnings are looking like and how earnings revisions are trending up for the market as a whole, not just the Magnificent Seven. On Monday, guys, I just want to see a gap and go, maybe even just gap up to all-time highs, pull back, close the gap, and then rally. So it looks something like this: gap up, pull back, rally. That would be pretty good, and continue the rally on the employment numbers, especially if the employment figures become good. But if we get weak data, weak earnings, we can actually pull back here, still be technically bullish. And that is the playbook for next week. Let's look at S&P 600. Now, small caps are looking much weaker. Now, we're just going to zoom in, looking at candle structure and location. Ignore this. This is the March monthly candle close. I don't know why mid caps didn't show the March candle. Maybe this is a different exchange, but this is the March candle right here. This is February's candle. And a green bodied candle, quite a big wick at the top, quite a big wick at the bottom, closing pretty much at the bottom of the 1/3 section. So still bullish. And looking at where we actually were at the start of the month, because we opened, came all the way down and then rallied, and then sellers found value right here. Looking at where we were, constructively bullish. Now we are actually pushing higher here in March, but at the same time, you have to look at it. We put a low, we made a higher low at the same time, making a high and approaching these highs right here. Now, small caps do have a lot of work to put in, but we are starting to see the glimpse of a breakout, and a breakout would be staying above this 1304 level, because we used as resistance right here, here, and here, sort of right here, but there's a bit of a gap there. Buyers did come in at these lows, and hopefully we can go ahead and break above these levels right here, maybe hit some new 52-week highs in the S&P 600. Looking at the weekly chart, we can actually see the chart is more nuanced. We put in a low right here, a high, a higher low, and what we do want to do is go ahead and break above right there. But zooming in, we can actually see there's a lot of price action happening in right here. Bulls are definitely winning, because you can see that we are putting higher lows along the way, and you know, we did go ahead, break above this 1304 level on a monthly basis. But on a weekly basis, what I really want to see small caps do is stay above this level right here, the bottom of the wick, 1279. On a weekly basis, we could pull back here, go ahead, make a new high, break this, break that, you know, go to these levels, confirm this breakout. That would be constructively bullish. But based on the amount of price action we're seeing right here, there is strong buy side support, and bears just can't take us down. Even despite we had this big red candle, buyers came in the 1240, 1260 level, bought the dip, and now we are making our way into the 1300, maybe to the 1400 level. On a daily chart though, things are looking a bit more dicey. What I do want to see is, again, we're going to use this exact same level as the weekly chart for the daily chart. We can pull back to here and then go all the way up, but we do not. I mean, even on a wick basis, want to go below 1279. What I really want to see Monday, Tuesday, bounce straight up. We get good economic data, good earnings, go ahead, break this high, break that high, and then start this breakout. And if we are to break out, let's go on the weekly chart. If we are to break out, a measured move would take us to this line right here. It also happens to be that high right there. So if we do start to break out, we can actually go to the 1423 level. And if we actually are to measure that from where we are right now, it's about 9.21%. And then to all-time highs, it's about 12.49%. But I think what small caps really need to do is the market really needs to see an improvement in the earnings picture. If small caps go ahead and do that, then they're going to start to rally. That being said, you have the levels. I gave you guys the key levels. We really want to see mid caps hold above the 1280, 1279 level and go ahead, break some of these key levels right here. Now we got some news off the Goldman Sachs research trade desk. I'm going to go ahead and read this for you. Now this is actually really interesting. It has to do with the cost of capital and where they see the S&P 500 going. So they say, contrasting today's growth stock rally with the growth stock euphoria of 2021. Now if you guys remember, 2021 was growth at any cost. That was why we rallied so hard in 2021. Now, the recent rally has driven the share price of market cap and stocks with extreme high valuations to levels similar of those reached during the euphoria of 2021. But the prevalence of extreme valuations today looks far less widespread than in 2021, after adjusting for market concentration. In contrast, with 2021, the cost of capital is much higher today. Investors are focused on margins rather than growth at any cost. These headwinds from a higher weighted average cost of capital also weighed on small caps. Quality is expensive and will tactically underperform when confidence in the inflation outlook improves. However, a higher weighted average cost of capital means valuations of small and unprofitable growth stocks are unlikely to return to the 2021 highs. And that's just the case, unfortunately. If you think stocks like Fubo and Zoom are going to get back to where they are, they're simply not, just because the environment isn't there. They only rallied because of the environment we were in, not because of any underlying fundamental strength. In actual fact, the reason why they are where they are is because they are fundamentally weak and now approaching their fair value. We could also see here that Goldman Sachs portfolio strategy predict EPS in 2024 at 241, 2025 at 256. That's an 8% and 6% increase respectively compared to the market's 9% and 13% respectively. What do I think is going to hit? I think somewhere in the middle here between the two. That's probably the most likely outcome. Now guys, I'm going to go over a bunch of bullish charts. So if you're a bear, turn this off. You will get PTSD. You've been warned. Now this one isn't super bullish, but it kind of is. And it's essentially when the S&P 500 performance is greater than 5% December to February, what can we expect in March? This is the December to February setup, and this is the March reaction. Now you can actually go down here and see 21 up years, 9 down years. So out of 30 results, we actually had 9 losses in total. So the reaction there is about 30%. So you have a 1 in 3 chance of March being in red, and a 2 in 3 chance of it being in green. Now it is more likely we are going to finish March in the green, but we can't discount this fact right here that at the end of the day, 30% of the time we probably will have a red March. Now we can actually see here that the average return is 1.33%. And you can see here that when we are green, we normally are green about 3% or more. Now there are times when we did get less than 3%, but you can see here that 3% moves are 11 from 2. And if we are green, we are very green in March based on a quarter greater than 5%. But when we are red, we are somewhat red except for one outlier right here in 1980. We were negative 10% in March. Other than that, the March hasn't been super red, but it can be negative nonetheless. Let's keep going with bullish charts. S&P 500 performance after a 2.5% December to February quarter is accompanied by an all-time high. This one is crazy. 16 instances, so we can't really take anything from it. We really need 30 instances for it to be statistically significant. Nonetheless, we can look at the stats. 16 wins, 1 loss, 15.5% average return. The only time we lost, 1987. Max drawdown excluding 1987 was no greater than 10%, and we should use this as dip buying opportunities to go long because the draw up far exceeds the average return in excess of 15.7%. So buy the fucking dip.
All right, I buy that. Thank you.
Moving on, a big February is red, but potentially bullish. And that's the thing, guys. Normally, February actually finishes in the red, but we can see here that when February gains more than 5%, these are the returns we can expect for the full calendar year. Now we only have 6 instances and now 7 in 2024, but we could see here that March reaction average return 2.2%, 83% of the time higher. The full calendar year normally positive 16.4%, only twice will be negative, less than 1%. The final 10 months of the year, 2015 was the only negative year, negative 2.9%, and the next 12-month return 13%, median 15.2%, 83.3% of the time it was higher. And this is very, very bullish nonetheless. So momentum brings momentum. We're going to keep going. Now, this is even more interesting, guys. This is the S&P 500 total returns cumulative, right? So the S&P 500, S&P 400, and S&P 600. So we got small caps, mid caps, large caps, and then we got everything together, and then we got the Dow Jones right here. And guys, this is, I really wanted to show you this because it's super, super interesting. We actually have a look at the last 10 years. This is really why I brought this chart out. The S&P 500 in the last 10 years, 230% return. Very, very good. It outpaced mid caps at 146 and outpaced S&P 600 small caps at 126. But look what happens when we move down the totem pole 15, 20, 25 years, particularly at 25 years. 556% total return in the S&P 500. Mid caps, small caps, 1000% return each respectively, almost doubling the S&P 500. And so guys, we do know that mid caps right now, the S&P 400 is trading at a 14x PE, small caps is trading at a 13x PE. When we do get valuations that are this attractive, you know, it's really prudent to go in and buy for the very long term to have absolute outsized returns, because we do know that the S&P 500 is trading at a 20x, very close to 21x historically high valuation. And this is actually a fantastic time to buy mid cap, buy small caps, and not just the 1500 as a whole. You know, go in, maybe stock pick, or just buy these indices as a whole, because they're trading at attractive valuations and they do produce outsized returns relative to history, even beating the S&P 500, you know, 15 years out. Now, this was an incredibly interesting chart, and something I actually didn't realize. The current bull market gains are not outsized relative to history. This is the S&P 500 returns in the first 2 years of a new bull market, the average of 12 bull markets since 1949, and the current, this is the range right here. And you can see this is us right now, the last 2 years, pretty much up to February 2024, and this is the average return, and we're not quite there, guys. So we could actually travel all the way up here, and we would be reverting to the mean of the average bull market since 1949, and we could probably go all the way up to here. Now, some of this is probably like 1995, 1996, 1997 tech bubble euphoria up here. That being said, we do have a huge runway that we can go to, and I know it sounds crazy, guys. I know this, when you do this, it looks absolutely crazy, but don't discount the fact that markets can remain irrational longer than you can remain solvent. Now let's talk earnings. Done with the bullish charts. I love looking at those, giving the bears some PTSD, but let's have a look at earnings this week. And we actually have not a big week of earnings. We do have a couple of big names, Costco, Broadcom as well, JD.com right here. But, you know, again, leading with that consumer trend, we got Target, we got Neo, we got CrowdStrike here on Tuesday. Famous earnings. There's going to be a lot of negative flows, probably in software as a whole, maybe even semiconductors. And we also have here Wednesday, we have Foot Locker, Abercrombie Fitch, Victoria's Secret, Campbell's. These are bellwether stocks for how the consumer's doing. Then we also got JD.com. What else do we have on the charts here? We got Broadcom for semis, Costco, MongoDB, DocuSign, a couple of hyper growth names right here. You know, CrowdStrike as well, like I mentioned before, Marvell, Samsara, guys. So not a big week in terms of market cap for earnings. Yes, Broadcom, Costco are pretty big. So too is CrowdStrike, JD.com as well. But, you know, we're going to really get a good idea of what the consumer is looking like, both in the fact of Costco and what like some of these hyper growth names are looking like, especially the leaders. We're looking at Broadcom, we're looking at CrowdStrike. Now, this is bottom up consensus, 2023 to 2025 sales compounded annual growth. So this is essentially what we're going to do for the next 3 years. Now, Nvidia up 69%. That is absolutely wild. Now, the Magnificent 7 is 12%, and I went and did the math. It's actually 17%, excluding Apple right here. The 493 is expected to grow earnings at 3% over the next 3 years, and then the S&P 500 as a whole at 5%. Now, this is sales growth, so it's just like top line. But yeah, you know, healthy growth rate here in the Magnificent 7. Not so much in the 493. really good to see how that's going to play out over the next couple of years. Now, this is some data I pulled up here. Now, essentially, it's the best sectors over the business cycle. So we got here the recession, the recovery, the expansion, and then the slowdown, and then the total return through the whole thing. Now, something to note, comm services is not on this list. Secondly, based on the market environment right now, the rate cycle, the economy as a whole, I think that different sectors are actually at different parts in the business cycle. Even though the business cycle is probably in some form of a recovery into an expansion, that's what I think where we are right now. I do think that stuff like real estate, potentially financials, energy, as well as like utilities are probably still in a recession, coming out of a recession. Probably industrials too, industrials at that recovery stage, recession into recovery, especially what we're seeing with manufacturing PMIs. I do think stuff like technology are past the recovery stage into the expansion stage. And I don't think any stocks are really in the slowdown. Now, out of all of these, right, healthcare actually performs the best apart from energy. Now, energy is great to hold in recovery and expansion, but we can actually see here that in a slowdown and recession, healthcare is really, really good. And this is why I said at the start of the video, I think healthcare is less of a defensive stock and more of an all-weather stock because it performs well in a recession, at least to the downside, performs great in a recovery, great in an expansion, and great in a slowdown. A total return across the entire business cycle for healthcare, 13.94%, second only to energy here at 14.87%, skewed by exceptional returns in the recovery and expansion phase. Now, guys, I was screening a bunch of stocks. I think there's incredible value in real estate. I was actually looking at some valuations. Some of these real estate stocks are priced for rates to be at like 8 or 9% in the next year. And I think a lot of real estate, especially commercial real estate and REITs that you can buy, are probably in this recession period right now, heading into the recovery. And I think it's a great time to buy REITs. I was looking at Vici Properties, AMT, SPG, Simon Property Group, a couple of Australian names, NSR, National Storage. I think they're really poised for, a solid comeback, especially if rates do come down. Now, rates can actually go up. We don't really know what's going to happen. I've been seeing reports that rate cuts might not even happen in 2024 with how strong the American economy is looking. That being said, I still think that based on where real estate is right now, this is a great value proposition right here. I think financials is also poised to do really, really well. And I think energy is undervalued. Just some data here that I wanted you guys to know. Now, I know a lot of you like technology, but it tends to be really bad in recessions for the most part and middle of the road here in slowdowns. And lastly, in a recession, consumer staples is the only sector that's positive in a recessionary period. And now, guys, looking at a trade idea for next week, this is very interesting. Snow, guys, I think that we look at customer sentiment. Even though Snow dropped 20%, 25%, customer sentiment was still pretty good. And I do think that right here, if we form a base buying at between 180 188 is going to be really good to go ahead and close the gap. I think the new CEO did something very similar to what PayPal did, and that was sandbag guidance for the future. And I think we're going to see a lot of beats here in Snow. Something else to note, that a lot of the other cloud names didn't fall as much. So I do think that this is a very attractive place to buy to go ahead and close this gap. We're not looking at a week or 2 weeks. We're looking at the next 6 to 12 months. So just a trade idea there for you guys. Now, data in the week ahead, guys. The major focus will be on the employment report and ISM services. So we got initial jobless claims. We also got the JOLTS reports. And then we got non-farms, private payrolls, unemployment rate, average hourly earnings, some big employment data that's going to really move the market. I believe that's either on Thursday or Friday. We also have the trade balance and then a couple of ISM mortgage applications, PMIs as well. So big week of data, big week of earnings, not quite as big as last week. The jobs numbers are going to be very key in determining market momentum next week. But if you've made it up until here, thank you so much for watching. If you like this video, guys, please subscribe, hit that notification bell, like this video, and please share it around and leave a comment for the algorithm. Cheers.